I'm sitting here. I'm sitting with the speaker here.
Yeah. I have also. You have slides. Yeah.
Okay, right.
You also have slides?
Only also.
I have slides, yes.
Okay, that's okay.
Okay, I'll see.
Yeah, because it would be nice also. We attracted to notice. It would be nice to hear also from the audience.
Sure.
Okay, I think we should probably start if that's okay with you. As we're waiting for the last people to walk in, please take your seats. And thank you for coming. I'm very well welcome. On behalf also of Bruegel, we are particularly delighted today because one of our own is presenting a very important and interesting book on crisis. Francesco Papadia, here on my right, who had worked for many years at the ECB and has had, no doubt, a lot of stories to tell, has written a very interesting book about central banking during the crisis. And today we will have a great pleasure to have also the book presented here. You've presented also in other places. And thank you for agreeing also to present it here at Bruegel. And as always, we always bring the opposition to this, to the arguments made. I don't know if it's the opposition, but certainly enough to talk about. I'm very delighted that Maria Nessen is joining us from the Riksbank, also very experienced economist when it comes to central banking, and Paul de Grauw, also a professor at the LSE, who is joining us with huge experience on EU and, of course, on central banking issues. We will start with a presentation by Francesco for 20 minutes or thereabouts. Then I will give the floor to Marianne and then to Paul, and certainly after that we will open up the floor for discussion. So without delaying further, Francesco, the floor is yours.
Well, thank you very much. It's a great pleasure to be able to share some thoughts with you about central banking after the crisis. Can
we put the slides on, please?
And the book is basically divided into three parts. And I can have a kind of a 5-minute summary of the book. In the past, say until the Great Recession, we had what I call a quasi-perfect central bank model. We thought we had reached a central bank model that was performing, elegant, complete, and I will tell you a little more about this model. Then this model was struck by multiple hits during the Great Recession. To the extent that the question, we can ask the question whether that model is still viable or not. So this would be the second part, is the second part of my book, and will be the second part of my speech, and indeed the predominant part of my speech. And the third part is, I call it a hesitant forward look, hesitant, timid, uncertain, because there are more uncertainties about the future as it tends to happen always than about the past. So this is my 5-minute, maybe my 3 minutes summary that has been expanded into 300 pages, which is this book. And of course, I have some gratitude that I might express to my co-author, Tuomas Välimäki, to authors of boxes that are in the book and are prepared by different people. And of course, when you prepare a book, you have a chance to present it to different places. I had a chance to present it here already to my colleagues, and their comments are included into these 300 pages. Okay, so let me start with what I define a quasi-perfect central bank model. My story really begins with the attempt that lasted nearly a century between First World War, when the gold standard was lost, to the end of last century, where there was this attempt to put together a fiat currency, a currency that had no intrinsic value, and price stability. And this attempt lasted about 1 century. And again, at the end of last century, we thought that we had managed to find this technology to put these two issues together. And this technology had different components. The first component was that price stability was on the top of the rank of objectives of the central bank. I mean, central banks have had, as Sveriges Riksbank, as the oldest central bank in the world, have had different dominating objectives over the centuries. Now, at the end of last century, there was an agreement price stability is the dominant objective, and that was the first component. The second component was granting technical independence to the central bank. By technical, I mean not objective. The central bank cannot choose its objective, can choose how to reach its objective, and specifically price stability. The third component of that model was that the interest rate, in a Wickselian approach, was the nearly exclusive tool of central banking. So an interest rate-based monetary policy. Then there was the Taylor rules, or different version of the Taylor rules as specification of the Wickselian approach. So the idea that you move interest rate up and down depending on two gaps, the inflation gap and the activity gap. Then further down in this descending order of generality, you had that the dominant monetary policy strategy was inflation targeting. Inflation targeting meant, in a broader sense, the idea that you have an idea of what inflation will be over the medium run, and you adjust your monetary policy, you adjust your interest rate to get to your desired level of interest rate. In that model, in that inflation targeting strategy, there was no real role for intermediate targets, either in terms of monetary policy aggregates or in terms of exchange rate or in terms of interest rate, with the exception of small exchange rate targeters like the neighbor of Marianne in Denmark. The last and the most operational component of that central bank model was the corridor approach to control interest rates, whereby you move the corridor if you want to achieve big changes in the interest rate, and you regulate liquidity to achieve a position of the short-term interest rate within the corridor. So that was a very brief description of that quasi-perfect central bank model that was prevailing before the Great Recession. Now, why quasi-perfect central bank model? Because there was really no place, no room in that model for financial stability. Financial stability was a neglected child of central banks. And the fact that financial stability was a neglected child of central bank avoided a risk of dilemmas coming to the fore in the use of the interest rate tool. So interest rate could be dedicated to price stability because financial stability was sort of forgotten under the tasks of central banks and the objective of central banks. And when it was not forgotten explicitly, it was forgotten implicitly, because it said the prevailing story before the Great Recession was, well, if we achieve price stability, by and large, we will achieve financial stability. So the two objectives are really collinear. You don't have to worry about possible dilemmas. The Great Moderation, 1985 to 2006 or 7, that 2 decades, seemed to be the ultimate validation of that central banking model. We had inflation was stable, activity was stable and high, and there was a sense that the superior monetary policy technology that we have achieved was contributing to this kind of nirvana situation, to this very performing situation. Now, we recognize that during that great moderation, there were imbalances that were accumulating. And I stress the now. In the book, there is a footnote where I say that I was one of the many that did not see the crisis coming, one of the many that were lulled into this idea that we had reached a very satisfactory situation. And with hindsight, it's striking that so many people, again, including myself, did ignore the stories that Kindleberger had started telling back in the 70s about the regular appearances of boom-bust cycles that Minsky had tried to theorize, and all the facts that Reinhard and Rogoff, all the empirical facts that Reinhard and Rogoff about this regular reappearance of financial instability had put into their book. So that is the model that was prevailing before the Great Recession, and this already took me 9 minutes of my allocation. So let me move to the Great Recession, and which were the damages of the Great Recession for that model of central banking. Now, I start off from an interpretation of the Great Recession that tries to avoid both the northern story, the northern interpretation, and the southern interpretation. The northern interpretation is it's all the fault of peripheral countries, southern countries, that let too much debt accumulate. The southern story is, no, we were in a very good situation, but then we were struck by a thunderbolt coming from blue sky in terms of a change of expectations. And my combined story is that, yes, some countries had put themselves in a very vulnerable situation because of imprudent policies. Some countries and some financial institutions had put themselves in a very vulnerable situation. And then they were struck by a change of expectation, a la Diamond-Dybvig, a change of expectation from a good to a bad equilibrium. But if they would have not put themselves into that position, they would not have had the crisis. And if there would have not been a spark coming from outside, we wouldn't have had the crisis. So the two components are necessary, and this is my way to combine the northern and the southern interpretation of the Great Recession. Now, what were the consequences of the Great Recession for monetary policy? Now, monetary policy was built on three critical implicit assumptions. The three critical implicit assumptions were, one, the central bank can control precisely its short-term rate. Second, there is a stable, orderly relationship between short-term rates and rates that are more relevant for the economy. I mean, nobody really cares about EONIA or about the federal funds rate other than banks and central banks. But the idea was that by moving EONIA, by moving the federal funds rate in the United States, the entire yield curve would move, the entire curve of risky rates that are more relevant for the economy would move. Now, this relationship was broken during the crisis because the spread went all over the place. They became very disorderly. And the third assumption that was negated during the crisis was the ability to put interest rate wherever it was thought necessary to achieve price stability. So we discovered during the Great Recession that there is a lower bound, maybe not quite zero. Of course, Marianne has some experience about negative rate, but not so negative. I mean, at a certain point in time, Taylor rules said that you should have put interest rate to -3, -4%, which you just cannot do. So these three things played havoc to a monetary policy that was based on interest rates. So what did central banks do? Well, they invented a new tool to complement interest rate, balance sheet management. Balance sheet management basically having a great expansion of their balance sheet, either in the European way with refinancing operations initially and then QE, or in the American way with QE coming much earlier. But in any case, expanding the balance sheet to a very large amount. And this indeed helped to remedy those three problems that I mentioned: regain control of short-term rates, bring back order in the relationship between short and longer, riskier rates, and ease even when you would have reached the lower interest rate bound. And I think that the thesis I tried to bring forward in the book is that this was mostly successful when it comes to financial monetary variables. Price stability was harder to regain. In Europe, as you know, we have not quite achieved it. And I dedicate quite some attention to the fact that there was an exceptional central bank collaboration, mostly between the Fed and the ECB, but more extended, that helped to reach these favorable results. There were consequences from the Great Recession not only for monetary policy, but also for financial stability. And financial stability, this neglected child, came back with a vengeance during the Great Recession. So it was ignored, and then it could not be ignored anymore. And the burden fell by sort of gravity on central bank shoulders. It was not so clear that they had to take responsibility for that. They are looking to their statute. But there were two abilities that made the falling on their shoulders inevitable. What I call the ability to assess. That is, the fact that central banks are the only ones who have a holistic view of the financial system. And then an ability to act. Central banks are the only ones that can do something forceful and quickly, which is basically providing liquidity. So financial stability struck back. So I here list what were the consequences of the Great Recession for financial stability. And the last two that are in gray, I have already mentioned under the monetary policy part. But the remaining ones, the remaining 6 ones, were serious enough to really make the Great Recession very, very grave from an economic point of view. Let me just mention the first one because of lack of time: the limited size of the trigger of the crisis. Now, the subprime component of the U.S. financial market was maybe 1.5% to 2% of the total. And this was enough to really create that enormous damage. And that is consistent with the Diamond-Dybvig story and the vulnerability and the change of expectation hitting vulnerability. In Europe, Greece GDP is 2% of the total. And yet, that little trigger managed to create a very serious crisis. So part of the answer of central banks to the financial stability consequence was just the other side of what they did for monetary policy. There were many what I call double-edged or dual-purpose measures that dealt at the same time with monetary policy and financial stability consequences. But there were also two specific issues, two specific actions that were taken on the two sides of the Atlantic. The US stress test and the EU asset quality review. And for a number of reasons, I say that the US stress test was much more successful, or was successful in a much shorter period of time than the EU asset quality review. As a consequence, the banking intermediation was impaired in Europe for much longer than in the United States. Maybe this has been recovered just now in some countries of the periphery of the euro area. Now let me come to the last part of the book, which is this hesitant forward look. Which were the hits to the pre-crisis central bank model delivered by the Great Recession? And I listed them in order of importance. So the first one I have already talked about, renewed responsibilities in terms of financial stability. The second one is a blurring of the border between monetary and fiscal policy. Now, let me be very clear. I don't think that central banks did what they did in terms of balance sheet management, in terms of QE, to help governments fund it. But when a central bank holds 25% of the public debt of a country, the border between monetary and fiscal policy is blurred, is no longer as clear as it should be. The third one is engendering moral hazard. When you help someone, inevitably you create moral hazard. Now, moral hazard has to be managed. It cannot be eliminated, should not be eliminated. You should not eliminate insurance contract. But you want to make sure that you properly manage moral hazard. The ECB was called in to salvage the euro. There seemed to be a lethal crisis for the euro. And governments seem to be unable to deal with it, and the ECB had to come in. And this is not something that a normal central bank should do. Then the ECB was called to participate in the Troika. They had to go to Greece and say, now you have to keep your shops open on Sunday, or you have to do this on your pensions. I mean, doing things that have nothing to do with the monetary policy responsibility of a central bank. And then the two global central banks, which are the ECB and to a larger extent the Fed, had to give more weight to global spillovers of their action. I mean, they could not, in any meaningful way, act as using the small country paradigm. That their action had no spillovers to the world. Their action had a lot of spillover to the world, and they had to recognize this during the crisis. So, given these hits, can we say that the pre-crisis central bank model has been jeopardized? Can we say that we are entering into another epoch in central banking? Charles Goodhart called the last epoch the triumph of the market. Are we entering now a fifth epoch for which we have no name as yet? Before answering positively to this question, I say be very careful. Think a lot before saying yes, because this attempt to find a monetary policy technology that would assure price stability with a fiat currency has been very long, has been very difficult. Don't throw the baby with the bath water. In order to answer this very general question, I break it into two. So, in two sub-questions. The first one, are the changes brought about by the Great Recession permanent or transitory? Of course, if they're transitory, fine. We don't need to do big changes. If they're permanent, that's a different story. And can we think of adaptations rather than radical changes to the model that could deal with the consequences of the crisis? Now, these two sub-questions can be further broken down into operational and institutional aspects. I don't think I have the time to cover the operational and strategic issues, so let me get to the institutional issues. Of the 6 hits that I mentioned, I think that we have to concentrate the attention on the first 3: financial stability, responsibility, blur, fiscal monetary policy border, moral hazard. I think the other 3 can be dealt with more easily. I mean, if we will have time, we will get to that into the question. But let me concentrate on these first 3. Now, on the financial stability responsibilities, the big question is whether macroprudential measures will free the central bank from dilemma situations. I presented this in Amsterdam, and of course I referred to Tim Bergen, as many objectives, as many tools. If we had 2 objectives, price stability and financial stability, and 2 tools, interest rates and macroprudential policy, well, you would have no risk of dilemma. Now, my answer to this, hesitant answer, but answer nonetheless, is that it would not be prudent to assume that indeed macroprudential measures will be able to deal in all circumstances with financial instability. So the risk of dilemmas is still there. And at least they're the reason why I reached this conclusion that macroprudential policy probably will not be able to deal with this problem in a definitive way. Now, on the question of the blurred borders between monetary and fiscal policy, I reach a somewhat analogous conclusion. Can we assume that the central banks will not need to use their balance sheet tool in such a forceful way as they did during the crisis, so that this blurring of the border will be a temporary thing that will disappear over time as the crisis gets back in the rear window? Now, this is very close to the issue of secular stagnation or not. Now, if we could say, oh, secular stagnation it's wrong, this is just a temporary period, we are getting back to a situation where we would have interest rates at a normal level, say 5%, so there would be all the room to come down with interest rate to deal with a recession, then you would say you don't need to use the balance sheet of the central bank in such a forceful way as you did during the crisis. Now, I hope this is the case. Again, I'm not sure this is the case. So you have to accept the risk that this question of the blurring of the border will remain. Moral hazard, somewhat similar story. I mean, they should have learned a lesson, those institutions and sovereign that needed the help during the crisis. They should not do it again. Are we sure that they will not do it again? No, I mean, we're not sure. We have some confidence, but not any kind of assurance. So what do we do with these three problems? On the financial stability and price stability possible dilemma, I propose a sequential approach. So we start from a situation where there is no problem of financial stability. The central bank is entirely dedicated to price stability. Then at a certain point in time, the central bank sees a dilemma coming up. And then it goes to its principal, say to Parliament, and says, I'm sorry, I have 2 objectives and just 1 tool, assuming that macroprudential tool has not dealt with the problem. Tell me which one I should pursue on a priority. And then the Parliament says, okay, you do this or you do that. And this lasts until the central bank says, okay, now we are back to a normal situation. The financial stability issue is out. I can return to my price stability issue. On the blurring of the border between fiscal and monetary policy, I been thinking quite hard whether I could propose something more clever than just special decision-making rules. So qualified majorities, say you need 2/3 of the members of the council. But I didn't. And so this is the only thing I propose, that this is a special tool that requires a special majorities. On the moral hazard, I just say, well, just use what insurance companies do. Insurance companies have deductibles. They let the sum of the pain on you. The form I put this, I call it Diamond Dybvik pricing, whereby you price your facilities at a price that is somewhat intermediate between the low price that would prevail in good equilibrium and the bad price that prevails in the market in the bad equilibrium. So the difference, some of the difference remains on the imprudent actors. As far as sovereigns, the leaving some of the cost on them also means that you don't give any support without conditionality. And I'm eager to listen what Paul would say about that. Okay, that's all I want. Thank you.
Lots to think about. I mean, the presentation is very much about the EU central banking, much more than world central banking, right? It would have been interesting to see a few differences between the US and the EU, because it would be primarily on architectural, I don't want to say limitations, but architectural features that actually change central banking in the Eurozone, and that may not be relevant for other central banks. But that's perhaps for later. With that, Marianne, your comments.
Okay, so can you hear me? Okay, good, great. And first, a word of thanks for the invitation to participate in this panel. I apologize to the audience. I don't have any slides, so you will have to look at that slide for 10 minutes. Okay. Now, let me say it's a delight to be here to participate in this discussion on Francesco's book. I had the privilege of working with Francesco during the financial crisis. I mean, it's now, we're nearing the 10-year anniversary of the Lehman crisis. And during 2007-8 and a few years on, Francesco and I were both members of the BIS Markets Committee. Some of you may have heard of this committee. This is a very important venue for discussions between central banks. You write a little bit about it in the book, Francesco, the importance of international cooperations between central banks. You mentioned now about the important collaboration between the Fed and the ECB. My impression is that parts of those discussions were being held in conjunction with the BIS Markets Committee meetings. You were a senior member representing a large currency area. I was a more recent member from a small currency area, but at the time, Bill Dudley was the Fed member on the committee. So it's very nice having this opportunity to talk about that time and to reminisce. Now, my remarks, my perspective here will be as one of a central banker. I've worked 20 years at the Central Bank of Sweden, the Riksbank, which is a tiny amount of time, considering that this year the Riksbank is celebrating its 350th anniversary. So a long time in my life, nothing in the life of the Riksbank. And just the usual caveat, any views expressed here are my own, and they are not necessarily those of the executive board of the Riksbank. First, just some general comments about the book. I thoroughly enjoyed reading it. It's a comprehensive and fascinating account of practical central banking written by an expert. I think there are a few people around in the world with such in-depth knowledge of central banking in practice as Francesco. The book is almost like an encyclopedia. So there's lots to read there. I admit that I haven't read every single page, but I will try to do so at some stage. And it does one of many interesting accounts is this careful account of the what happened during the financial crisis. And I hope that sometime in the future, Francesco, you get back to writing a memoir about and many of the anecdotes are available from those days. Now, your book, it covers the past, the present, and the future of central banking. And my remarks, I will talk about the future, some different themes regarding the future. I will try to interject 2 questions to you during this talk, Francesco. So I hope I don't forget to mention them to you. So I will talk a little bit about the future. I will also talk about some reviews that are being made, because this reassessment that your work your book is part of, it has led to many countries reviewing the legislation concerning their central bank. So I'll talk a little bit about the reviews in Sweden and in Norway. So some comments regarding the future and the future challenges to central banks, and do we need to change this model that you described in your book? A few points. You mentioned the area of financial stability, and the topic of central banking and financial stability. That is, of course, one area that's been debated a great deal in the past few years. Now, I think we need to keep separate here 2 aspects. Central banks' responsibility for financial stability. I mean, I think there's a large consensus that central banks have a large role in safeguarding financial stability. But it's another question whether monetary policy should be used for the purpose of safeguarding financial stability. Many of you know that there's a very lively debate about this among academic circles, and many prominent economists argue against it. My personal note here is that this is not a yes or no question. I think one can fruitfully apply the concept of different lines of defense here. But here I do have a question to you, Francesco. And so should we use the interest rate in order to safeguard financial stability? And in a symmetric sense, not just cutting the interest rate, but also perhaps hiking interest rates. You ask, does the model need to change? Or should we go back to the pre-crisis model? Well, my take is that, yes, we do. We should not go back to the pre-crisis model entirely. There is an important caveat here. We should not go back entirely, because I think we learned lessons during the financial crisis that have to do with the fundamental purposes of central banks and some fundamental objectives, and it has to do with liquidity provisioning and also financial stabilities. I think during the Great Moderation, those things were forgotten, and I think that what we have learned during the financial crisis should be incorporated into our framework. So I agree with you there. So back to, so to speak, back to the plumbing of central banking. There's a lot of plumbing going on in the financial system, and the central banks need to be aware of what's going on. Regarding the future, central banks, we navigate in, not in difficult territory, but in a territory that varies greatly over time. And of course, I mean, it's obvious to say that the economy around us changes, but it does change in fundamental ways. And this is perhaps sometimes not sufficiently recognized in our frameworks. So I'll just mention a few of these, the changing environmental factors, so to speak. I'm sure you've heard them all before, but let me just go through them nonetheless. One very important factor, and which Francesco talks about in the book, is that of declining real interest rates globally. Now, that is the key driver of the low interest rates that we see today. It's not due to central banks sort of freely choosing from any any level that they want. At the heart of our economies right now are very, very low real interest rates. Some people like to call them neutral rates. Whatever you call it, real interest rates have not been so low for a long time. That is something which is a factor of first order for central banks going forward, how we address that. Other structural issues, globalization, this has been going on for decades, of course, so, and we're increasingly more and more perfect factor markets, more and more freely moving factors of production, more and more integrated financial markets, the rise of truly global markets, product and financial markets. This has been going on for decades, but I think we still don't fully understand how this affects inflation. I think many central banks have inflation which is too low if you compare to their objectives, and I don't think we perhaps fully understand how globalization has affected the process of inflation. We have, of course, and also technological change also affects the inflation process. Now, I think it's important to note that what I've mentioned here is not just stopped monetary policy, of course, to counteract, to address all these issues. For example, real rates, low real rates reflects expectations about low growth going forward, and monetary policy is not the first line of defense there. That responsibility lies squarely with other policy areas. So all structural policy that will address that is conducive to higher growth going forward would be is important. But nonetheless, we are in this environment, and I think that it's not certain that, but the probability that we will be in this low interest rate environment for the foreseeable future is very high. And therefore, it's very important that we keep our options in the central banking community. Interest rate policy needs to be complemented by other areas going forward. We need to keep the option of using our balance sheets. You mentioned negative rates, so let me just talk about that very briefly. So Sweden is one of a handful of areas in which we have negative policy rates, and this policy has proved to be successful. It's worked quite well. But let me note that it's mildly negative interest rates. It's not deeply negative interest rates. There's a lot of research going on in the academic community about how to make possible deeply negative interest rates. I personally don't see the possibility of that being put into practice in the foreseeable future. There are many, many things we don't understand about deeply negative interest rates. So I think to be prudent, central banks need to keep these new tools that they developed during the financial crisis, they need to keep them in their toolbox. Now, I mentioned the reviews. So in Norway and Sweden, the central bank legislation is being reviewed as part of, partly as a result of lessons learned during the financial crisis. Now, let me just remind you, in case you have forgotten, Norway is not a member of the European Union, but Sweden is. But we have our own currency. So both Norway and Sweden, we are inflation targeted for the past 20-25 years. The Norwegian bank, central bank, has had an explicit inflation target since the early 2000s. The target is set by the government. This is an important difference between Norway and Sweden, because in Norway, the central bank is an authority which reports under the Ministry of Finance, okay? Target is set by the government, and they recently changed the inflation target from 2.5 to 2.0. so they lowered the inflation target. What the government recently did was also that they issued, I think it's called an instruction. I'm not quite sure of that term, but they issued an instruction to the central bank, whereby the target was lowered from 2.5 to 2.0. But they also said that the central bank should take, one of the goals of monetary policy should be to safeguard financial stability. Previously, the Norwegian central bank had sort of alluded to that in their interest rate setting, but it had not been officially recognized, so to speak. So in March of this year, an instruction from the government to the Norwegian central bank said that going forward, you should of course safeguard price stability, but you should also take into consideration financial stability and counteract the buildup of financial imbalances. That is their wording. So that was an instruction from the Norwegian government to the Norwegian central bank. In Sweden, we're members of the EU, so our central bank is an independent authority under Parliament. And our legislation very much resembles that of what is stipulated by the Maastricht Treaty. So in the Riksbank Act, it says that the purpose of the Riksbank has two tasks: price stability and a safe and efficient payment system. Nonetheless, there is a review going on, and the issue of financial stability is one of the factors being looked at by this commission. They started last year. This commission is not going to be finished until next year, so there are no results. I cannot tell you about how the discussions are going because I don't know. But one of the hot topics is the Riksbank's responsibility for financial stability. Now, there's a background here. Macroprudential tools were given to the FSA in Sweden in 2013. So the central bank does not have any macroprudential tools, but there are other tools: liquidity provisioning, and perhaps interest rate. But they will be finished next year, and we'll see what happens then. So just to sum up then, I really enjoyed reading the book. I've mentioned one question, and the other question, which is my last one, and you talked about this in your presentation, Francesco, that when it comes to solving this dilemma between monetary policy and financial stability, the central bank could ask a relevant political body, and that they would make that trade-off the choice. I was just wanted to hear your thoughts on how that would sit with central bank independence. Okay.
An important question. Okay, but why don't we move straight to Paul's comments, and then we can perhaps, if you can keep your reactions for after Paul, that would be great. Yeah.
Okay, there it is. Thank you very much for inviting me. It's a great pleasure to be here. It's not the best part of Brussels, but it's still it's still good to be here. No, I was driving here and I couldn't get in. Anyway, no, I like to be here. Let me make that clear. I also like to. I think, yeah, this is a great privilege also that I could comment on this book by Francesco and Tuomas. I liked it a lot. It's great. It gives us so many important insights on how to conduct monetary policies in crisis times. And it's written, you feel it, by somebody who has been close to the practical implementation of policies. And for an academic, this is always quite important to be aware of this, right? We tend to idealize things, and it's good to be brought back to earth by a practitioner like Francesco. I would like, there are many points that I could discuss, of course, but I would like to take two out of them. One is about the fundamental causes of the impairment of the transmission of monetary policy in the Eurozone. I mean, we have seen, and Francesco describes that in great detail, how the transmission of monetary policy has been impaired during the crisis, right? but I'm going to concentrate on the Eurozone. And then the zero lower bound, if I have enough time, if you permit me, Maria, to do that. The impairment of monetary policy transmission in the Eurozone. There are two dimensions to this problem, or two ways you can have an impairment. One has to do with the fact that the policy rate may not transmit easily to the lending rate because of a banking problem. The banks hold reserves. That will typically be the case after a banking crisis, right? A liquidity trap and all this. And that's something that we have seen both in the US and also in the Eurozone. But then there is something which is much more specific for the Eurozone, and which is that the transmission of the policy rate across countries has also been impaired, right? And that's very typical for the Eurozone, right? That's not something you find in the US. And I will argue that this has very much to do with the instability of national government bond markets, right? And I will focus on that issue. So, of course, I'm aware that the other one is equally important, but I will focus on the problem that is specific for the Eurozone, right? And this brings me to this idea of the instability of the sovereign bond markets in a monetary union, in the Eurozone in particular, right? We all know what the origin is. The governments in a monetary union issue debt in a currency that is like a foreign currency, right? And they are not backed by a local central bank, and as a result, they are subject to self-fulfilling liquidity crisis when, especially during recession, this is going to happen. It happened during the last recession. It's likely to happen again during the next recession when investors will want to get out of one bond market and move into a bond market that is perceived to be safer, and as a result creating large destabilizing capital flows. That's the feature of the Eurozone, which is not there in the US, right? It's a typical feature of the Eurozone. A fundamental cause is the lack of central bank support of sovereign bond markets, automatic central bank support of sovereign bond markets. And this can lead then to multiple equilibria, good and bad equilibria. And then, of course, the transmission of the same policy rate will be impaired. Francesco puts a lot of emphasis on the Diamond-Dipwig model, which is okay to describe the banking crisis and the banking run, but not okay to describe what is going on in the Eurozone and the movements from one sovereign bond market. It's similar, but it's not the same. And my criticism, if I may, Francesco, is that you probably apply it too much also to the Eurozone, and you should have done something different there. And so my criticism also is that you don't go enough into the specificity of the instability in the Eurozone, which is the result of the fact that this is a monetary union with one central bank and 19 different sovereigns, right? And that creates a very different problem of management also. And that is a little bit underdeveloped in your book. That's my feeling. You tend to put the Fed and the ECB quite often in the same kind of analysis. So how to deal with this, right? How to deal with this instability in a sovereign bond market and the fact that with each recession we risk to be confronted again with destabilizing capital flows because these recessions don't have the same intensity, right? There will be governments hit more than others, and then investors are likely to run from the first one and go to the other one, right? And that will again bring the problem there. What should the ECB do? The ECB has announced OMT program. It waited too long to do so, in my view, but anyway, they did it in 2012. But it lacks credibility. When we ask the question, is it going to be used during the next recession when spreads increase again? Are we sure it will be used? I'm not so sure, right? Basically because the OMT was set up to solve an existential crisis, but not something recurrent that we may have to do each time there is pressure in sovereign bond markets as a result of a downturn in economic activity. also, I think it's loaded with too much conditionality. You asked me the question, Francesco, what I think about conditionality. It's loaded with too much conditionality because when do you want to use this thing, right? When there is a recession. Because that's when the crisis, the liquidity crisis and the capital flows will occur. And that's when you will impose conditionality, that is austerity, during a recession. That's when you shouldn't do it, right? So that's not the right way to do it. And therefore, I think it's unlikely to be used because some countries may just not want to use it, right? And finally, it depends on the goodwill of civil servants. That's a big difference between a sovereign nation, a government that is backed by its own central bank, and there the government will always prevail over the central bank. When the government is in trouble, there can be no doubt that it is the government that will prevail over the central bank. That's not the case in the Eurozone, right? No government prevails over the ECB today, right? And as a result, we are dependent on the goodwill of civil servants. Who will that be? We don't know. So therefore, this whole thing has little credibility, right? It's, and therefore, we are still there. Now, I'm going to skip that, otherwise the safe asset is not a solution. Okay, but I'm going to skip all this, otherwise I will never finish, I think. So what is my solution? Well, in fact, some kind of what you have called balance sheet management, the composition of the balance sheet. That is, that the ECB, in fact, should commit itself to maintain spreads within certain bounds, right? Say something between 1% and 2%. And then we come close to what you say, deductibles, right? You would say, for example, the Italians are in trouble because investors sell Italian bonds. So the central bank then says, okay, we are going to intervene, but we first let the interest rate increase a little to 1, 1.5 or 2% or something. So a kind of more, to prevent moral hazard, right? They still have to pay a little more. But then we commit to buy these assets, right? To avoid that we are pushed again in this kind of destabilizing situation that we have seen in the past. That's what...
Just for clarification, what do you mean? So let's say some countries' bonds go beyond the 2%. Then the ECB buys these bonds to be invested.
That's right. That's right. You have the corridor on the interest rate, right? You do something similar. The central bank is used to work with corridors, right? You could do it here too, which means that you would do some kind of asset management, you would change the composition of the assets, right? In order to make sure that this kind of destabilizing capital flows does not undermine the system and does not lead to worse system. And this will then also help to have reasonable transmission mechanism, right? So that would be my proposal, and it fits a little bit in the kind of terminology that we have been using now, namely, we will have to continue to do balance sheet management, right? And especially in the Eurozone, it's key that we do that in the composition. I know it's not going to be popular in some countries, what I propose, but I don't care.
it's a common problem. Yeah. It's worth thinking about.
Okay. Okay, it's last point I want to make. Can I make that point?
Please do.
The zero lower bound. Should inflation target be raised? Francesco discusses this. It's not a very big, long discussion, but it's one of the issues that we face for the future, right? The 2% that is now sacrosanct, right? Is that really what we should maintain? Francesco has some sympathy, but in another way then rejects this, mainly because of the transition, right? How do you go from 2 to 3 or 4%, right? These are reasonable arguments, so I'm not going to discuss these. But what I want to do now, I want to present a little bit of the research that I'm doing with behavioral macroeconomic models, right? You give me the opportunity to make some advertisements, right? About how to do macro in a different way. So I've been constructing a behavioral macroeconomic model together with Yume Ji, and that's a model in which agents have cognitive limitations. They cannot have rational expectations. That's too difficult. I don't understand the world, and therefore rational expectations is implausible. Of course, I know in macroeconomics, if you don't use rational expectations, you don't get published, huh? So that's the problem that I have these days. Anyway, but I don't care. That's right. I'm in a position that I can say, I don't give a damn. So, and this is a model that produces endogenous waves of optimism and pessimism, animal spirits. You produce it endogenously. It has to do with the fact that in this world, for some trivial reasons, people who have optimistic views about the future, right, may at some moment take over. And since this is self-fulfilling, this will tend to lead to a boom, and the boom itself enhances optimism, and you get a dynamics that creates optimism, euphoria, until the crashes come, right? And that's what this model predicts. When you ask outsiders, they will say, is that all? We knew that this is the way the business cycle works, but that's not how macroeconomists today think, right? They think that this cannot happen. I mean, rational agents would never be driven by excessive optimism and pessimism. These are notions that they don't understand academic macroeconomists, right? But I have this approach. And then what I did, I used this model to simulate under different assumptions of the inflation target, right? And I'm going to very briefly show you, I'm not sure this. So I show you on the left-hand side movements in the output gap when the inflation target is 0, right? And then below is the movement of the animal spirits, right? And then I put the same stuff in the frequency domain, right? The output gap on the right-hand side is the distribution of the output gap in the frequency domain. And below, on the right-hand side, is animal spirits, also in the frequency domain. And what you see is that when inflation target is very low, 0% in this case, then you get skewness. That is, pessimism prevails. Because the economy is pushed into negative territory, the central bank has no tools to bring it out. And since the economy is in a recession, people are pessimistic. Pessimism maintains the recession, and you create chronic pessimism. And that's the skewness that you see there, right, in both the output gap and in animal spirits. And then you raise the inflation target to 2%, and you see more symmetry. But there is some skewness left over, right? When I go to 4%, then it's purely symmetric. Then periods of optimism and pessimism alternate in a symmetric way, right? So we did a lot of analysis of where exactly should we be. Here's a sensitivity analysis where on the horizontal axis, I set out the level of the inflation target, and then on the vertical axis, the skewness of the distribution of the output gap, right? And when inflation target is very low, then it's very skewed to the left. Lots of recessions, lots of pessimism. When you increase the inflation target, you bring the economy closer to symmetry, where optimism and pessimism alternate in a symmetric way. Interpretation, when inflation target is too low, cyclical movements in output gap and animal spirit lead to recessions that drive inflation into negative territory. When that happens, the zero bound constraints make it impossible for the central bank to lower the real rate further, right? And that creates this chronic pessimism. If the recession is deep and the deflation intense, the real interest rate is likely to increase, in fact. And a recession becomes protracted, pessimism sets in and amplifies the recession and validates pessimism. And so that is basically the story I get. And therefore I'm saying, well, let's think about out of the box. I know today 2% is, you cannot touch it, right? If you say, oh, it's impossible, right? But think out of the box. We have chosen 2%, but why? Nobody knows why we did that, right? And here's some evidence that this may be, in fact, too close to zero, creating conditions of what I call here chronic pessimism. And just by ways, you don't have to go to 4. In my simulations, something around 3% would, in fact, do most of the job for you. And you can, in fact, live more happily. Thank you.
Okay, wonderful.
For your attention.
Thank you so much, Paul. A lot of interesting things as we think about monetary policy in the future, and also the role of models and the role of expectation formation. Francesco has to deal with all of this in practical terms.
That's right.
Francesco, why don't you perhaps pick and choose on a few points that Marianne probably...
I will have to choose. I mean, if I get a general message from this is that I should go back to Oxford University Press and ask for a second edition as quickly as possible so that I can take into account all the comments that were raised. Short of that, let me deal first with a question of Marianne. Should the interest rate be used for financial stability? And I think you made a very relevant point, that the discussion on this is huge and inconclusive. It's huge. Many people say, no, you have to lean with interest rate against excessive optimism that leads to financial instability. No, you have to keep interest rate firmly assigned to price stability and think about something else. Now, to me, the reason why we have so much discussion and so little conclusion is that this is an issue that cannot be answered in analytical terms. This is, at the end, an issue of preference. That's the reason why a technical institution like the central bank doesn't have political independence to set its objective, to do arbitrage between two different objectives. It's a bit similar to the situation of the Federal Reserve that has an inflation target and an employment activity target, and somehow they have to arbitrage, and I think this creates some difficulties for them. That's why I say, no, you cannot deal with that just in economic terms. That's a political choice, so you have to go back to your principle, whomever your principle is. And to make it a little more specific, my sequencing story, I see that as a dilemma starts to appear, there should be as much as an attempt as possible to use macroprudential measures to deal with it. And I don't take position whether the macroprudential measures should be taken directly by the central bank or should be taken by someone else. The central bank should be, in any case, associated with these macroprudential measures, but I don't take a very strong view on who should take them. In any case, okay, you see financial stability issues coming, you try and use macroprudential measures, and you see whether you deal with the problem. If you don't deal with the problem, then comes my you go to parliament story. And to answer the question of how this fits with central bank independence, this fits in the way that it is the central bank that calls for a dilemma situation and for the end of the dilemma situation. So it's not the government that can say, I see that there is a financial stability issue, so you please do that. No, it's the central bank that has to go to Parliament and raise this dilemma issue. So another point that Marianne raised is going back to the pre-crisis model. I mean, in one of my slides, I said I don't favor radical solutions, but there are people who have been favoring radical solutions. One radical solution, if we go back to making central banks a glorified government department. So we go back to the 70s with exception that central banks didn't have technical independence. And they were part of the government, glorified because they were called in a different way. Maybe salaries were a bit higher or something like that. But basically they were part of... And I think that model has been tested and failed. I mean, for countries that had that model did not control inflation in a proper way. So I think it's it would be unwise to get back to that. Then the other radical solution, I think Willem Boyder has made this point, is you go back to a narrow central bank. A narrow central bank that only has the interest rate and only has price stability. For the reasons I mentioned, I think this would not be prudent. It could be, and I think you made that point, that they would have to use again balance sheet management for that. They would encounter a dilemma between financial and price stabilities. Now, on the first point of Paul that has to deal more with what I said, but then I would say something also about your behavioral model and its consequences. Now, to me, what you are trying to achieve is a situation of fiscal dominance. The central bank has to finally accept to fund the government. Now, you say, okay, I want to have a 1 to 2% margin corridor. But when you get to that, you get to fiscal dominance. I mean, the central bank has to print enough money to fund whatever that government is doing. And the government doing it will just go to the border. Okay, I will have to pay 1% more, no more than that. I just do whatever I wish with my deficit and my budget. And I think that what we have in Europe is a situation where intrinsically you cannot have fiscal dominance because there is nobody that can order the central bank to print money. With your system, you get back, in my view, to a situation of fiscal dominance. The other related point here, I mean, who was affected by the Great Recession? Who was affected? Not Germany. Why not Germany? Not the Netherlands. Why not the Netherlands? Not Austria. Why not? Italy, Greece, Portugal, Ireland, Spain, Cyprus. Countries that had run imprudent policies. They put themselves in a dangerous situation, and yes, they were hit. I mean, you cannot deal with that unless you have some degree of responsibility remaining on these countries. Now, on raising the inflation target, as you rightly say, I don't say no. I don't say yes either. I'm skeptical about the usefulness of increasing it, say, from 2 to 4%. I recognize that the 2%, there is an element of conventionality. I mean, I don't think you can show that 1% is much worse than 2 and that 3 is much worse than 2. I mean, we chose 2. It seems that this has become a kind of universal Greek P. I mean, in central banking, everybody's Sweden is on 2, ECB, the Fed, Japan, Switzerland, the UK, everybody in advanced economies is on 2. But we have made a big effort to tell to agents, think about 2% as being the permanent rate of inflation, which we say for some reason is close to be 0, price stability in real terms, because we know that in genuine terms, we know we cannot properly measure inflation. So maybe it's 1 billion people now in the world that has this convention in mind and work and decide upon this convention. Yes, it's a transition cost to move away from that. But it's a big transition cost. I mean, why are we still using AZERTY on our keypad? Because, I mean, we have never managed to pay the cost of moving to A, B, C, D, A, F, G, A, and so on and so forth. And then looking at your charts, I mean, maybe we would have to move from 2 to 3%, from 2 to 2.5%. Is it really worth its while? Or if we find again a zero lower bound or a lower bound of a non-zero lower bound, as Mariana says, okay, we will be forced to use again our central bank balance sheet in order to ease monetary policy even when we have reached. So what is the relative cost of having to use continuously, again, balance sheet or raising the inflation target? The arithmetics of this cost-benefit analysis is not clear to me.
Okay, Francesco, thanks very much. I think we need to collect a few questions, but before we do that, can I ask a question myself on your proposal on the sequencing? So you have the central bank coming into dilemmas, and with these dilemmas, it goes to the parliament. Tell me which one do you want me to pursue? There needs to be a trigger mechanism there. For the central bank to behave in a different way than normally, there is a trigger mechanism there. And trigger mechanisms by themselves could be quite distortionary. So, we've seen this with exchange rate bans, we've seen this, anything that has got a ban, so a condition beyond which I do something else, is in itself distortionary, and there is also a build-up coming up to the threshold that actually precipitates the behavior that you are trying to avoid, because it is a crisis behavior. So while I see the merits of what you're suggesting, the practicalities of this is that it would be quite difficult to implement. Very much actually on a par with what Paul is suggesting, on the buying the debt in order to keep the rates down. It's got merit, but as you say, it translates to monetary financing effectively. So I was wondering, how is that going to play out for somebody who's interested in the practical parts of this? But before you answer, can we collect some questions from the floor? So I have Andre, I have Jorius, and Martin. Yeah.
Thanks. It was a fascinating presentation and discussion. Two questions that relate to what Paul said. The first question, let's take seriously what Paul suggested, which I basically agree, is that we cannot really compare the ECB to the Fed, right? They are both central banks. They both a lot of technologies, but there is a difference, right? We are a monetary union. The US is not a monetary union. So first question to Francesco, could it be that the looking forward part is different from the ECB and for the Fed? That is, the Fed returns to the ex-ante situation, but the ECB has learned that it cannot return to the ex-ante situation. The ex-ante situation is a lot of trouble ahead, continuous problem. And what would be the implication of those two largest central banks in the world behaving going forward in this different manner? One going back to the old model, to the pre-crisis, and the other one saying, no, I cannot go back to the pre-crisis. That's the first question. Second question is, in a sense, to Paul. What you suggested with this band, okay, it was discussed, I remember, right? We remember that. Exactly the way you suggest, right? To put a cap on the, in a sense, this is what has been implemented. Very late in the day, but that was implemented. Now, however, I think what Francesco says, hey, wait a second, you do this, you are inviting to certain behavior. Let's say you announce this today, and before this new Italian government comes about, and is it the license for the new Italian government to say, well, we can do whatever we want because, the ECB ensures that the penalty that I'm paying to this is not worse than whatever your cap is concerned. So my question is, although I think it's a good idea, don't you think that this good idea needs to be put in place in conjunction with something else? And then what is the something else? What is the something else? Is this fiscal rules that are credible? Is it imbalanced procedure that are credible? What is it? Don't you think that we need something? And what is the something?
Thank you, Andrea. You're also a question?
probably not much different from what Andres said. But my question has to do with the kind of historical background of this crisis that I think the Eurozone crisis to a great extent, you know, a banking crisis, though we put Greece always, but the Greek problem is not a banking crisis. The beginning was fiscal, but all the others banking crisis, which somehow it's a financial stability problem. And the question is why central bankers haven't seen this thing right from the beginning, meaning from 2000. What was really, they couldn't hit the lessons of Hyman Minsky, you know, at least said the basics we recalled, that if you have a crisis, you need a big bank, which we have, but you need a big state, which we don't have. And then we have to resort to the ECB using all the conventional measures and arrive at the court also to validate the ECB's position. I mean, are we ready to repeat probably the same mistake? And the second question relates to Sweden, talking about financial stability. How Sweden feels being outside the Eurozone and probably, you know, a coverage that, you know, Euro area could offer in terms of, you know, of financial difficulties, having in mind Nordea models and so on. Are there any ideas in this respect?
Yes, thank you. I have a question on the choice of the inflation target. Now, in his presentation, Mr. Papadia refers to the ECB as a technically independent institution, which I suppose is the instrument independent, so it can decide how to pursue an objective, but the objective is given. Now, I'm not an expert in monetary policy, I admit that, but my understanding is of the ECB that the inflation target is not defined by the principle, but only the, let's say, the price stability objective. And then, again, I'm not sure I fully understand the legal details, but then it is the ECB who sets the inflation target at 2%. Now, we have heard that it works differently in other jurisdictions. So what would you think is the specific benefit of having, and I'm agnostic about the different solution, but from your point of view, what is the benefit of having the central bank also deciding about the specific target? So to me, the ECB seems to be a mixture between instrument independence and objective independence.
Francesco, why don't you take the word first?
Okay. Let me try. How the proclamation of dilemma be called. Yeah. Now, in my sense, this would not be a mechanical kind of exercise. This would have to be an assessment, maybe a judgment at the end, an articulated judgment by the central bank that would see stock prices going too high, real estate prices going too high, debt going too high, spreads, risk spreads going too low on an aggregate basis in the euro area or in the United States, having tried macroprudential measures of one kind or the other, loan-to-value ratios or loan-to-income ratios or dynamic capital charges, and the phenomenon continuing. And then the central bank would produce a big book, go to the parliament with its big book, and the final 5 lines would say, notwithstanding all what we have done, we think that unless we raise interest rate, we will continue having financial stability issues. Now, given that we don't have inflation where we would like it to be because it's too low, or maybe we are even in deflation, this will aggravate the inflation problem. Tell me, should I give more weight to the inflation, to the price stability, or to the financial stability? And then Parliament, in my would do the political arbitrage and say, well, in current conditions, we think that this objective is more important than the other.
If I may, in the Eurozone, because that also comes into the question that Andres, how would that work in the Euro area?
Well, in the Euro area, the parliament, in my view, would be the European Parliament. So and the ECB would go to the European Parliament, the Fed would go to Congress. I imagine it would be, I don't know whether the Senate or the House. I mean, now, on the question of André, I think that, and this partly answers one question that you raised, whether the book is really on the ECB or on the ECB and the Fed as it is presented. I think that if you do count words, there is more on the ECB than on the Fed.
It's the ECB in here the different type of central banking, and that I think is underdeveloped. That's my view in the book, right? And does not take into account the specificity of being a central bank of a monetary union.
I'm glad that you find a deeper reason. My reason, when I thought about this, I said, well, just because I've been working at the ECB for 15 years, and so I know more about it, then I wrote more about it then, but maybe there is not only that. In any case, I think that the problems of financial stability, possible dilemma with price stability, the problem of the blurred borders between fiscal and monetary policy, the problem of moral hazard apply to the Fed as well as to the ECB. The other ones are specific to the ECB. So in my sense, what I propose, for instance, in terms of sequencing, I would say, well, I would propose it for the Fed as well, because then you know that the Fed has this dual objective. They think they've dealt with that by balanced approach. They may say that they can juggle 3 objectives instead of 2, but okay. So no, I don't think that the story is completely different between the Fed and the ECB. Now, George, why was not seen from the beginning? Basically, I don't know. I don't know. You know that the Queen of England asked this very specific question, and she didn't get an answer. And and if you read the book by Reinhard and Rogoff, it seems that, but by the way, also Kindleberg in 1978, I think it was, or Minsky. It seems some inability of maybe some having to do with behavioral limited rationality to recognize that we have had crisis for 300 years, but every time we think that we're not getting the next one, or that if there is a financial crisis, that will be for developing economies. Advanced economies have graduated away from them. So. Now the last question of what is whether we are in a mixed situation in Europe because the treaty only says price stability and the 2% was identified by the ECB. In a way, I think this is a second order issue. I mean, the ECB, given that it's price stability, could not come up with something like 8%. They would have not been under any possible definition of price stability. They could have come up with 1, maybe they could have come up with 3. They said, okay, if we look at how inflation is actually measured by statistical offices, we know that there is a bias. And so if they say 1 is most probably 0, and then some other discussions about the ability of, if you have a little inflation, it's easier to do relative price changes. So they came to this 2%. But again, as I said, there is a lot of convention in that 2%. I mean, there is no hard science beyond this 2%. But conventions matter. Conventions. Last point, negative interest rates. I mean, in the book, there is a chart I'm very proud of. I took data from a thick book by Homer and Silla, History of Interest Rates. And I tried to see whether going back 5 millennia, so to Babylonian times, and whether there is any evidence of negative nominal interest rate, and I could not find it. So it seemed that nominal negative interest rates are just a premiere in 5,000s of history, just to stress how exceptional the situation is, which gives some support to the idea that it's natural rates that are so low that maybe we are in something like a secular stagnation period.
Thank you, Francesco. Sorry, yeah.
Can you respond to?
Yes, of course, yes. Yes, please.
Okay, yeah.
You have the last word.
No, I'm sorry.
Don't worry, of course.
To respond to Andre, I think that is, I fully agree with Andre. Central bank and monetary union is a different animal from the central bank in one country. It's obvious.
It's off, actually. Yeah. Do you have a... Oh, it's fallen.
Oh, that's what too wide.
It's because we are we're live streaming, so... Yeah.
This miniature.
Yeah, thank you.
Yeah, so and the issue here is a fundamental instability of sovereign bond markets. In the past, when we had a fixed exchange rate system, the instability was in the foreign exchange market. We solved that by abolishing the foreign exchange markets. And we thought we had solved the instability. But now we pushed it to the sovereign bond markets because the sovereigns are making promises that are not credible. That is, that they will pay back their bonds in a currency that they don't have, right? Which was also the problem of the foreign exchange market. They were promising to convert their domestic currency into a foreign currency at a fixed price, and that the foreign currency, they may not have it. So now we have something similar in the government bond market. So we face this problem, which the Fed does not face, and we will have to solve this. The first best solution is merge the bond market, right? But that is so far out. This is the ultimate political and budgetary union that we all dream of. All, no, but not all, but I dream of. But that is so far that we can only dream of. Therefore, we have to find practical solutions, because this will come back, right? So that is why this is one of the proposals. And of course, Andre correctly says this creates moral hazard problems, right? How do you deal with the moral hazard problems? Here I would say, yeah, you have to separate what the central bank is, the kind of firefighter, and the others, right? The firefighter should not try to, when it has to extinguish the fire, should not be the policeman at the same time and first catch the guilty person, right? So, and we have an institutional setup that tries to control build-up of debts and deficits, and that has to be there. Of course it has to be there. But still and I want to stress also when this is about the spreads, right? A cap on the spreads, not the yields. So you want to have a cap on the spreads. And then if you have, say, a 2% cap, then yeah, you take some care of moral hazard, because it's not free. It's a deductible, right? It's a way to deal with it. So we will have to do these things, right? It's not that we have no choice, and you cannot just say, okay, we'll not do it. It will come back. So we do this, or we have to do other things. And then what is that? European Monetary Fund, maybe? But will it have sufficient resources to deal with this? You need a central bank that has the credibility, and that central bank has that because it has potentially unlimited resources. So I think we have to face this problem. It's not enough to say that with moral hazard, we have to try to deal with it, of course.
Thank you, Paul. Marianne.
Okay, the question on on being outside the Eurozone, well, two parts to that answer. The first, if you use traditional macroeconomic theory and the choice between fixed and floating exchange rates, I think many will point to the advantage of being outside the Eurozone during the financial crisis. The krona depreciated, inflation did not drop as much as feared. Our recovery was faster than our neighboring countries. And actually, Giancarlo Corsetti and two co-authors have a nice little piece on this in the Riksbank Economic Review available on our website. But there's more to this issue, and here this is not my area of expertise, but I think many people are thinking about what it means to be a small open economy with an advanced financial sector, but also being a very small currency area. This is tricky questions, but it's not my area of expertise.
Is there anything else you would like to comment on?
No, not right now.
Okay, that's great. Thank you very much, because we are actually running a little bit late. So thank you very much, all. Francesco, first of all, for giving us the opportunity to read your book, and our guests who have taken the time to read and comment on this. Please thank our guests and join me in thank you.